Friends, yesterday we talked about the concept of the risk which causes the losses, because we are ultimately not forgetting that we have to find out how much is the adequate capital. Capital adequate is that which can absorb the expected future losses, and then how to calculate the future expected losses. We have to understand that the losses take place because of the risk. How these risk causes the loss, that we will be in terms of the finance, we will be understanding in the future episodes. But we have to first understand the concept or basic concept of the risk. Yesterday we understood that the risk is an event, correct? So when anybody undertakes any activity, whether it is financial or non-financial, crossing the road, moving, driving a vehicle, climbing a hill, any type of the activity, then during the course of conduct of that activity, there is the possibility of an event or more than one event taking place, possibility of an event or more events taking place, which if take place, then there can be any type of the loss. So when this loss will take place, only when that event will take place. So sometimes we call the risk as an event. That event which may cause the loss is known as the risk. Even in the finance, such type of the risks are there. We have to understand. For example, a bank or a financial institution, it undertakes many type of the financial activity. One very common one is that accepting deposits. Now, if a financial institution undertakes the activity of accepting the deposits, there is the possibility of an event or events happening. What are those events? They actually are the which may cause the loss to the bank. Banks are also giving the loans. Then this activity is giving the loans. So when a bank or financial institution is undertaking an activity of granting advances, of giving credit, there is a possibility of an event or more than one event taking place which may cause the loss to them. They are making investment activity, leasing activity, hire purchase activity, any type of the activity. There is always the possibility of an event or event taking place, which if take place can cause the loss. Now, we will go further into the basics. How this risk is managed. Risk management process. Now, there are same asset, but this asset can be exposed to many type of the risk. First, we have to understand that in an activity, there is not one risk or one event taking place. There can be many events taking place, or that is many risks is to one single asset. This example can be understood by an activity of driving a motorcycle or driving a vehicle. I give an example. One of my friends, who was of course my senior, much senior to me, and we were staying together in Guwahati, and there his son, he loved his son very much, and he never said no to his friend ever, his son ever. So he was my boss. He was my boss, and he purchased a new car. And that time that car was very costly and a very new luxury car. Now his son wanted to take, a only son, so he wanted to take that car. That son had no license, he never drove the car, but he was so innocent, he said, Papa, I want to take this car and to my friends. Father had never said no to his son, but he knew if you take this car there is a risk. But how to tell that? So he said, yes, son, you take this car, but there is a risk. Then the son asked, what is the risk? He said, beta, that is a police risk. He didn't understand. His father gave the risk a name, police risk. He said, what is that police risk? He said, when you will take this car on the road, then while you are driving the car, there is a possibility that a policeman may stop your car and may ask for a license, driving license. So what? No, it is necessary to have a driving license. If you do not have got the license, then the police may arrest you, put you behind the bar, confiscate, fine you. So there is loss of reputation, loss of asset, loss of money. Oh, I understand. Oh, ho, ho, ho. Now, how to manage that risk? Normally, the legal way of managing the risk. Many people in this country are managing the risk in illegal ways. In financial industry also, there is many illegal, unethical, immoral practices are there to manage risk, which we will discuss later on. So, this police risk, which his father said, the son did not have a license. But then he said, Papa, don't worry, I will manage that risk. His father was worried and how can you manage? You don't have got a license. Now you see, that is how the people were. He said, Papa, I know. He took out the purse, showed him the 500 and 1000 rupee notes and said, Police wale ko denge, I will give it to him and I will be away. Oh no. Father thought this man wants to take the risk and he says that he will manage in this illegal manner. How to stop him? Because he doesn't know. Then he said, oh yes, you take, but there is one more risk. He said, what is the risk? You just told there is one risk that the police risk. No. Driving has got more risk than this police risk of asking. What is the another risk? Another risk is risk of accident. What is this accident? Beta, when you will be driving the car, then because he did not know how to drive the car, then there is a possibility that you may hit any object or hit any other vehicle, or any other vehicle can hit you. So that is the risk, and then there will be loss of life, loss of vehicle and all that. Oh, acha, I see. Then he said, don't worry, I will call my friend, he knows the driving and he will take the car. Father said, this is the new car, this fellow doesn't know, I don't know about his friend, how not to make him to take the risk. He said, all right. Now he added one more risk to the same activity of the driving that new car. He said, well, you may take it, but there is another risk. He said, what is that risk? And the child is managing that risk by some way or the other, like police risk by bribing, by this another risk by making his friend to drive the car, like that. And now father didn't want him to take that risk. So he said, there is another risk. What is that risk? Risk of theft. He said, what is the risk of theft? Once you will take the car, you may park the car, and there is the possibility that where you park the car, there may not be anybody to safeguard it. You may leave your key in the car, you may not lock the car properly, you may leave it at a unguarded place. So there will be a loss of your vehicle. He said, don't worry, Papa. I will make sure wherever I park there is a safeguarding. I will check that all the doors are closed. I will take the key out. Oh, now should I take? Papa said, no, 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 no. There is another risk. What is that risk? Risk, like that father went on telling him, risk of fire, risk of natural calamity, risk of riots, so many risks he added. Then ultimately the child said, ठीक है मैं नहीं लेके जाता, I will not take, because there is only one car and you are telling me so many risk of theft, risk of fire, risk of accident, risk of police and so many things. I will not take. That is what the father wanted, and ultimately the child. But there are institutions and the people who first thing don't understand the risk in the activity which they are undertaking, and either they are trying to manage it illegally and they know that they don't know how to manage that risk, still they take it, and that is why there are failures, whether they are many cooperative banks failing, many banks failing, many financial institutions failing, many businesses failing, because these are the people who do not know that the entire business is the business of the risk. No risk, no gain. Higher is the risk, higher is the gain. So in search of the higher gain, they take higher risk, but they don't understand the risk. Anyhow, now the first thing is that in a risk that one should identify the risk associated with any asset. Any asset, like here there is a vehicle, so there are risk of fire, risk of theft, risk of accident, like so many. Now what is the net? Not only you identify the risk, but also understand how that event takes place. What is that event and how that event takes place? Like police risk. He didn't understand what is the police risk. But then the father made him to understand the type of the police risk means what is that event. Event is that the police will stopping, ask for the license and there is no license. This is the event, understanding that risk. Then you can think of managing the risk by, yes, I will obtain a license, I will, like Rastogi ji was trying, he was trying to manage the risk. He knew the risk without traveling ticket in the train, there is a risk, but he was trying to manage it in the legal manner, that is by purchasing the ticket and then only getting into the train. So, first thing is that you identify the risk, and second thing is that you understand the risk. Understanding the risk means what is that event which takes place may cause that type of the loss. Alright. Then the third is not only understanding the risk, but you must develop the skill to manage that risk. Now, what is that? I will give you an example. In our childhood, we were near a place very near to Agra. My father was there. So as a child, very often we were going to see the Fatehpur Sikri, and I think that fellow is still there, or his son is there, sorry. So there near there is a Buland Darwaza in Fatehpur Sikri. A person used to go to that at the top of that Buland Darwaza, which is about more than 178 or 175 feet above. Everything ground is full of the red stone. There is a Baudi. Baudi means a well, and a person used to go to the top, and from there it used to jump and straightway was going into the well or the Baudi, which must have been more than 200 feet. Now it may be around 500 feet. He will put the fire on his clothes and will jump, and then he will come and ask for money, 1 paisa, 2 paisa, like that. And entire day he will jump so many times, but at the end of the day he will get only 5 rupees. Now if anybody else would have never dared to jump that. Even today, someone told me that there was in DD, there was one program, Surabhi or something, on where they had shown a person who is jumping still now, but he charges minimum 500 rupees. And the guide pays him 500 rupees, he goes up and now I say anybody is ready to go to that Bulandarwaja, I will give him 500 crore instead of 500 crore, but only after he jumps and comes out safely from Bulandarwaja in that well and come out. Bare body means no other tools. Nobody will be ready. Nobody will be ready. Even if I give him 5,000 crore, he will say, what is, if I will lose my life, then what is the purpose in jump? But that fellow is jumping and he is not letting even 500 rupees to earn. There is an opportunity to earn 500 rupees, he is not letting it go. But here I am offering 500 crore and you are letting that opportunity to go. What is the difference? You will say there is a risk. Arey, risk, what is that risk? No, if I will jump, then there is a possibility that instead of going to the well, I may hit the stone and I may die. Arey, the same risk is for that man also who is jumping for 500 rupees. For him also the height is the same. For him also the stone is the same. For him also the head is made up of the same bone. But he is taking that risk and letting not even 500 rupees to go out of his hands, while you are allowing 500 crore even to go out of his hands. What is the difference? Difference is the skill in managing that risk. That fellow is taking the same risk which you are not taking. Risk is the same. Difference is the skill in managing that risk. He has that skill. So you know the risk. He also knows the risk. He knows the event. You also know the event. But the difference now comes. You have to develop the skill to jump that 500 or whatever, that 300 or 400 feet height, how to jump. That is. Now suppose, and the ability of everybody to develop the skill is not the same. Some can have the better or the higher skill, some may have the lower skill. For example, swimming. Swimming is an activity and it is a skill. Some people, everybody can try, but some people cannot develop the skill of swimming outside the swimming pool. Some they may go up to the pond, some may go up to the river, some may even go to the sea, but all cannot go into the sea. So it depends upon, everybody can sing to some are bathroom singers, some are the stage singers, some are, everybody cannot become the Lata Mangeshkar. So developing the skill has got a limit. So the identify the risk, understand the risk, and then develop the skill through practice and the tools. This is a major, entire risk management depends upon how to develop the skill to manage that risk. That we will talk about in the later episodes when we will go into the nitty-gritties. Now, once you have developed the skill, and skill is the different for everybody, then the next step is in the risk management is to know your limits. To know your limits, up to what limit? That is what the people say, calculated risk. Every wise people say, I don't take the risk like that, I take the calculated risk. If the child asks, someone's child asks, Papa, you have taken so many risks in the life, you are a wise man, you must be taking the calculated risk. Show me one of the calculation where you have taken the risk in your life. Nobody will be able to say, because we sometimes parrot the words without understanding them. Now here, the calculated risk. Now what is this? Once you have developed the skill of swimming, jumping, or investing, or lending, or borrowing, now you must know your limits. Whether I can swim only in the swimming pool, or do I have the skill of swimming in a pond, do I have the skill in swimming in a river and all that. And once you know your limit, fix your limit. Know your limit and fix your limit. This is my limit. Now in finance, when we were talking about the fixing the limit and credit score or the credit rating, and then your other interest rate risk, how much you can take, etc., etc. We will talk about that. Right now we are talking about the basic thing. Now knowing your limits, that is up to how much extent you can manage the risk, or you have the skill, fix your limit. Once you have fixed the limit, these all steps are before taking the risk, that is before starting that activity. These are pre-risk activities or pre-activity, the activities before taking the decision whether to take that risk or not. These are identifying the risk, understanding the risk, developing the skill, and fixing the limit. Now you can undertake that activity or that risk. Then what should you do next? Here now comes the calculated risk. How to calculate the risk? For example, if I ask someone that there is a 5-storied building, if you jump from the first floor, I will give you 10,000, second floor 1 lakh, third floor 10 lakh, fourth floor 1 crore, and fifth floor 10 crore. Jump from which floor you will be jumping. Here return is also there and risk is also there. First floor if you jump you will get only 10,000. Fifth floor if you jump you will get 10 crore. Now what should you look at before you think of earning 10,000 or 1 lakh or 10 crore? What you will be looking at? You will now be calculating, you have calculated the return 10,000, 1 lakh, 10 lakh. But now you will be calculating the risk. How much is the risk from jumping from the first floor or the second floor or the fifth floor? How do you measure that risk? What is the indicator of the risk in this case? It is the height of the first, second, etc. floors. If the first floor is 10 feet and then you say, oh, I have already learned the jumping skill to jump, I can jump from 15 feet also, high also, and this is only 10 feet. It is within my limit. I will take that risk, earn 10,000. Someone who had developed the skill of jumping from 30 feet, he will measure first floor is 10 feet, second floor is 20 feet, third floor is 30 feet. He will say, well, I know the skill, I can manage that risk of jumping from 30 feet. Third floor is within my limit, within my skill, I will jump. He will earn 10 lakh of the rupees. Now, this is the height is the indicator of the risk. So, look before you leap, means measure the risk before you take that, not only the return. 90% people, they only, in the financial world I have seen, they only look at the return, they are not looking at the risk, they are not calculating the risk. Risk and return both have to be calculated. And not only that, you have calculated the risk, you have developed the risk, you have fixed the limit, now you have calculated the risk also. Now next question is that once you have calculated the risk, now will you jump or not? That you will see whether it is within, then you will see two things. Once you have measured 10 feet, 20 feet, 30 feet, 50 feet like that, then next step will be compare how much is the risk and how much is your skill to manage that risk. And then you will see this one thing, yes, how much is the height? Height is 10 feet, I can jump from 15 feet, I will jump. But that is not the only point to be seen. Risk and return, they should be commensurate. If I am trying to jump from suppose 10 feet, how much return I am going to get? If suppose 10,000, it may be commensurate. But if suppose it said I will give you 1 rupee from first floor, though I have the skill, I can jump, but that is the return is not commensurate with the risk which I will be taking. So both these things, how these two things are calculated, that is the risk and also the return. How they will be calculated and then compared, that we will talk in our detailed videos. Thereafter, now you jump. Now you jump. That it means now I have done everything has been completed, measuring the risk, developing the skill, and that risk and return are commensurate. So now I can jump. Yes, you jump and go on jumping as many times in a day as you feel like. So every time you are going to get 10,000 rupees, 100 times you jump, then 100 into 10,000, you will get 10 lakh of the rupees. Now the question comes whether now the risk management is over. No, it is not yet over. Then what is left here? Nothing is going to change. Yes, it is going to change. What is going to change? What is going to change? Return is already told. Height is also fixed now. This 10,000, that 10 feet will remain 10 feet only. No, it may increase or decrease. How can it increase? First floor will remain where it is. Yes, first floor may remain where it is. But your reference point where from you are measuring your height of 10 feet, someone suppose digs down on the ground floor. Then it digs down another 10 feet. Now this 10 feet first floor is at its own place. But how much it become? Now it has become where you are going to fall is 20 feet. That means the risk is not static. Risk is dynamic, it goes on changing. Environment changes, regulation changes, so many things changes. So at the start of that activity, once you measured the risk, risk may not remain the same. Risk may increase or decrease. Oh, increase तो समझ में आ गया, किसी ने खड्डा खोद दिया, someone digged, so the height increased and the risk increased. There is another possibility. Some may put some soil over it, so what was 10 feet, that may remain only 5 feet also. So risk it is not. That is why A may become double A, or double A may become single A. Now there are lot many instances where there were the investable grade bonds, they became the junk bonds. So that the risk is not static, it goes on. So what is the need to survive? Survive is that monitor the risk continuously, not only measure, not only calculate, but constantly, periodically monitor. And this, if the banks have forgotten this, that is why they are not monitoring their risk, and that is why their NPA, or whether they are in loans and advances or investment, they are increasing because they do not know how to monitor. Anyhow, so next step in the risk management is to monitor the risk. Constantly monitor whether the risk is increasing or decreasing by monitoring, supervising, following up that activity and the environment in which that activity is taking place, or any that condition which may impact on the risk profile. You must do. Now what is the next? अभी क्या रह गया? अभी तो कोई लगता है कि मॉनिटर भी कर रहे हैं, मॉनिटर करने के बाद भी कुछ रिस्क रह गया. Oh yes, there is a risk. Still, what is that risk? Now suppose you are driving a vehicle. You are driving a vehicle, all type of the risk you are taking care. It is kept in perfect condition, maintained properly, brake, everything. You are monitoring the speed also. You are following the rules of the road also. Everything, and you think there is no risk. Yes, there is a risk. All these risks which you have so far managed are within your control. But there are certain risks which are uncontrollable, which are not within your control. For example, when you are driving the car or driving the vehicle, someone else may hit you for his fault, not for your own fault. So despite taking all, for example, everything was going on well for a particular business, suddenly the government policy changes, regulation changes, and it affects that particular business adversely. So that may also to be kept in business. Now that cannot be controlled. These risk steps which you took earlier, they were for increasing the profit, but uncontrollable risk which is which is beyond your control, there always the loss is going. If someone hits your vehicle, there is not going to be any gain for you, but there is only loss. then you have to avoid that loss. How to avoid that loss? If you are driving a motorcycle or the vehicle, you have to put on the helmet, you have to have the belt, and so many things. So these are called the risk management tools, which in the finance are the derivatives. They are the derivatives. We will talk about that. So next step is having the risk management instruments or the tools. Put on the helmet, put on, so that the loss can be minimized. There will not be any gain out of it, but only thing is that the loss. Thereafter what? Thereafter another step is that TK, but the vehicle will be damaged, someone may be injured, then what would happen? How to minimize that loss? For that you get the insurance. Insurance in finance is called the capital adequacy. Bring adequate capital. That we will talk. So this is the last step. Insurance is the last step in the risk management. If I ask many of my students, suppose you have got a vehicle, you want to manage the risk associated with this vehicle, what will you do? Their first answer is insurance. I said, all right. That means once you have done the insurance, the risk is eliminated. Then you take it under a truck and say, I have got the insurance done. So there is no risk. No. What is the purpose of the insurance and what does it do? That is the last step. Nobody wants his insurance to be encashed. Today you take the insurance and tomorrow you want it to be encashed. No, it is the last thing to be encashed. So there are 8 steps. Identify the risk, understand the risk, develop the skill, fix the limit, measure the risk, compare the risk and the return, undertake the risk, monitor the risk and manage the risk and get the enough capital. That is the insurance. Capital adequacy is nothing but the insurance and get the insurance. This is what the 8 steps of. How they are implemented in case of the finance, I will be telling you in other videos.